Welcome to Money Mastery, where we discuss all things finance for everyday life. Welcome everyone to another episode of Money Mastery. I'm Peter Van Beek, a certified financial planner and chartered financial consultant, and I'm joined here with Matt Suttner, and we're both advisors at McGlone Suttner Wealth Management Group. Today we're going to be talking to you guys all about IRAs. So Matt, to get us started, can you lead us off with traditional IRAs?
So what is an IRA? An IRA stands for Individual Retirement Account. Basically, it's a long-term savings account that individuals with earned income can save for the future while enjoying tax advantages. Unlike a 401k or a 403b, however, it's not tied to your employer. So no matter where you're working or if you switch jobs, it's still your account.
Great. Okay, so kind of getting into how is this account taxed, what are the advantages, and who can use these accounts?
Yeah, so money that you contribute into this account is put in pre-tax. So it's not taxed before it goes in. Once it's taken out as a distribution later in retirement time frame, it's taxed as ordinary income.
Okay. So to kind of give you guys an example based off what Matt's saying, so if someone makes $100,000 in 2023 and you put in $5,000, when you file your taxes for that year, your taxable income would be $95,000. It deducts from your taxable income.
Yep.
It's taxed later when you pull it out. So Matt, with these tax benefits that you get for doing this IRA, can anyone do this, or how do you determine if you're eligible to be able to do this account and take advantage of these tax deductions?
Yeah, not everybody's eligible, unfortunately. It really comes down to how much money you make. There's some income basically limits or phase outs once you hit certain levels where you are not eligible to contribute anymore. For a single, it's $73,000. For a married filing jointly person or couple, it's $116,000. So you can't make any, if you make above that, you can no longer contribute on a tax deductible basis.
And to kind of give you guys the example, this is the beginning of the phase out, so you'd be able to do portions up to the end. We're only talking about specifically the beginning of this phase out because we're going to get into reasons why later on in this episode, so stick around. So with that being said about these income limits of who can do this, if you are eligible and below the beginning of this phase out to maximize the full contribution into these accounts, how much can you do into an IRA?
Yeah, because it is such a very favorable savings vehicle, the government puts limits on how much you can actually put in there every single year. Okay. For 2023, the limit is $6,500 for anyone that's under the age of 50. If you turn 50 in a specific year or you're older than that, you can actually put an additional $1,000 in for a total of $7,500.
Okay. So anyone that's made money in this year can put that in, and then based off your age, you can put in $6,500 or $7,500.
Exactly. Remember, you have to have earned income for that. Okay. Also, you don't have to put it in this year. You actually have until tax time in the following year to make your contribution for the current year.
Okay, so if I file my taxes in April of 2024 for 2023, if I have some availability and room left to put in, I haven't maxed that account in, I can still put in money?
Correct.
Okay,
Yep.
Good to know. So with that being said of how much you can put in, who's eligible, what can an account holder that has money in here, when can they access this money? When can they get to it, and in what circumstances can you pull money out of this account?
Yeah, the answer is technically any time, but there's a couple catches, so you got to be very careful. Okay. So first, if you're under the age of 59 and a half and you pull money out of this, you're going to not only be paying tax as your ordinary income level, but you're also going to be assessed a 10% penalty for whatever you take out. So you got to be very careful because that could get very expensive based on your current tax rates plus that 10% penalty. Okay. There's also what's called a required minimum distribution. Basically, the government says, hey, you have not paid tax on this money since you put it in, even before you put it in. It's been tax deferred. We need to get a little piece of that money at some point because they need the tax revenue. So they actually start forcing people to take it out of their account at a specific age. In 2023, the age has actually just moved this year to age 73. And in 2033, it's actually going to move to age 75.
Okay, so that required minimum distribution, otherwise known as RMD, that's when you're forced to start taking some money out.
Correct.
But you wouldn't have to before that.
Yep.
Okay, Great. So that's good to know for everybody. One big thing still on IRAs to discuss why is an IRA an important retirement tool. We've kind of hit on a lot of these pros and cons of the account. Can you kind of explain and summarize for the listeners what the maximum benefits are of these accounts and why you should use them?
It basically allows savers to set aside money tax deferred. So you put it and take that as a tax deduction, more or less. So if, like we talked about earlier, the $100,000 example, if you make $100,000, you put $5,000 into an IRA, you actually reduce your taxable income by that $5,000 and you pay less in taxes today. But you will have to pay that in the future, but it's allowed to grow tax deferred until you take it out.
Okay, good. That's good to know. With that kind of covering the traditional IRAs, is that the only IRAs out there?
Yeah, there's another IRA account that we want to talk about, and that's the Roth IRA. So Peter, can you tell us what is a Roth IRA?
Yeah, absolutely, Matt. So a Roth IRA is an individual retirement account where you actually contribute this money after tax dollars.
Okay. And so how is it taxed, and what are some of the advantages of having this account?
Yeah, so some great advantages of a Roth IRA. One, like I mentioned, the Roth contributions are made with this money that's already been taxed. So how does that work? Once the money is in the Roth IRA, you invest that money, you let it grow, and when you pull that money out, it's tax-free. So unlike the traditional IRA where you're paying no tax up front, but you pull it out and you pay the tax then, with the Roth IRA, you pay that tax up front, put it in that bucket, let it grow, and pull that out tax-free. Assuming you're following the rules, which would be the following. Any amount up and to the equal to your contributions that you physically put in, you can always pull out at any time, tax-free, penalty-free.
So what do you mean by that? So if I put in $20,000 over the last several years, I can still pull out the $20,000 even though I'm not 59 and a half?
Yeah, so great question. So if you put in $20,000 and it grew to $40,000 over the last, let's say, 5 or 10 years, you can always pull that first $20,000 that you directly contributed at any time before age 59 and a half without paying a penalty.
That's good to know.
That's a big thing with the distributions. Now, we wouldn't always recommend that, but if it ever came down to an emergency situation where you needed that cash.
I always look at it as like a break glass moment, right? That fire extinguisher, you got to break the glass to get it. That's kind of what I'm thinking.
Exactly, right? So, and then any growth on that money, so that 20 to 40,000 example like we talked about, any growth that you put in, that comes out penalty and tax-free if you are over age 59 and a half, like we talked about with your traditional IRA, and as long as the account's been open for at least 5 years.
5 years, okay. So the account had to be opened 5 years ago in order to get at that with no penalties.
Correct, for that growth.
Yeah.
So as long as it's open for 5+ years and you're over age 59 and a half, the growth can come out tax and penalty-free as well.
So people should try to establish a Roth as quickly as possible so that they can get that 5-year clock started.
Exactly. If you have the cash flow and the means to do so, yes, we would recommend being able to start that clock.
Okay. So who should be investing in these things?
Yeah, so a good thing that we talk about is with a lot of clients is, should I do a traditional IRA or a Roth IRA, Matt?
Right.
And a big thing, if you were in the same tax bracket now as you are in retirement, we'd say it doesn't matter. You'd be taxed at the same rates if you looked at it from a mathematical standpoint. Now, if you expect to be in a higher tax bracket in the future, for example, you think your income will increase over the next couple of years or tax brackets are going to increase, then a Roth IRA would be a greater advantage to you because we'd expect you to get in at this lower tax rate now before you're making a higher amount and in a higher tax bracket in the future. So you're saving yourself that gap in that taxes there by doing a Roth IRA and paying that tax up front versus doing the traditional IRA, pulling that tax out later.
Sure. Okay. And then we talked about this a little bit with a traditional IRA, but how much can you actually put into a Roth IRA?
Yeah, so great question there. It's actually the same. Government makes that part easy for you, where it's the same amount as a traditional IRA. So you can do that $6,500 for anyone under age 50, and if you turn age 50 in this current calendar year or you are already over age 50, you can do $7,500 for that additional $1,000. One thing to keep in mind is it is indexed for inflation, so those numbers typically will go up a little bit every year or every other 3 years.
Right. So do you have to have earned income for this too? Just like a traditional?
Yeah, so you have to have earned wages. You have to be working a job where you've earned income. Now, the one caveat I will say about that is if you're married filing jointly, say your spouse didn't work, but you did, and you made at least, let's say, $15,000 if you're over age 50, or $16,000 or $13,000, you could contribute to both your accounts as long as you're married and one spouse has that income.
Sure.
If you are single, you have to make that enough income to be able to contribute. So we say the limit 6,500, but you only made 5,000 this year, you can only do 5,000. Okay. So the lesser of your earned income or the contribution limits, usually people have a lot higher earned income than the contribution limits, but one thing to keep in mind.
Yeah. And with the traditional, there were some limitations on how much your income you could actually have before the government doesn't allow you to put into it anymore. Is that the same with a Roth?
Yeah, so there are phase-out limits. They're higher than a deductible traditional IRA, but there are income phase-out limits. And the phase-out limits begin for a Roth IRA when you're single at $138,000. And if you're married filing jointly, the beginning phase-out starts at $218,000 for your guys' combined income. And the reason we're talking about with you guys, the emphasis on the beginning of that phase out is just to fully maximize these accounts and the tax benefits. You're going to be way more advantageous doing the full 6,500 or 7,500 if you're above age 50, doing that full amount to a backdoor Roth strategy versus if you're in the middle of that phase out limit for the traditional IRA or Roth IRA and only doing, say, $2,700 into it because you're in the middle of that phase out, so it's deducting you as you get higher into that phase out. You're just going to be more advantageous if you're above that threshold at any point to do the full amount backdoor versus only doing a partial amount directly to that deductible IRA or Roth IRA.
So Peter, let's just say, for example, my wife and I make $250,000. We're over the Roth IRA contribution limits, but we still want to either contribute to a Roth IRA or maybe even a traditional IRA. Is there a way that we can do that?
Yeah, there is. So this is actually called a backdoor IRA.
A backdoor IRA. Okay. Can you elaborate on what that strategy is?
Yeah, so a backdoor IRA, for anyone that doesn't know, it's a strategy that high income earners use because you're above that beginning phase out for the traditional IRA and the Roth IRA.
Right.
So how we use this is benefits you is you get the same benefits of a Roth IRA, but even though you don't qualify for that. So we're using actually both a traditional IRA and a Roth IRA to complete this backdoor.
Interesting. So what are the mechanics around that? How does that actually work logistically?
Yeah, so good question. So we're actually, like I mentioned, you're going to have to use both a traditional IRA and a Roth IRA. One important thing to know is you got to have a traditional IRA that doesn't have money in it. So this is including a simple IRA, a SEP IRA, anything along those lines. You can't have money in any of these accounts in order to do these backdoor IRAs.
So if you don't have a traditional IRA, but you have a SEP IRA or a simple IRA somewhere else, perhaps, you can't do this strategy, is what you're telling me? Okay.
Correct.
You have to have nothing in those.
Yeah, you have to have nothing or very limited amount that you would be converting to Roth. And the reason for this, Matt, is so we're putting this money in order to do it. The mechanics of this is we're putting it into a traditional IRA, but it's a non-deductible.
So you're not getting the tax advantage.
Exactly. So like we talked about earlier, where you put that $5,000 in the $100,000 earner example, you don't get that tax discount right away. So you still are paying taxes on that money. Your income's still $100,000. The nice thing and benefits though of this is you're putting that into your traditional IRA, and then we put that in shortly after. There's no magic number to this, but some advisors will do it right away. Some wait a month or two, but then you convert that traditional IRA money that you put in there to your Roth.
Oh, interesting. Okay. But if you're converting it into a Roth, is that also acting like a contribution? Will that count as a contribution for that year?
Exactly. So this is the same contribution limits as a traditional IRA, Roth IRA, because you're still utilizing this IRA vehicle. The thing is, so you're going to do the 6.5K if you're under age 50, or that additional 1,000 catch up for 7,500 if you're turning age 50 or older.
Okay.
You cannot do a traditional IRA or a Roth IRA, obviously, and the backdoor Roth. Obviously, your income limit's too high, but all of these you cannot split between the two IRAs or multiple IRAs. One thing to keep in mind. So you can't max out a traditional IRA and max out a Roth. And the same thing, you can only do the limits for a backdoor IRA. Now, the benefit with this, and you'd say, why would I want to go through this complicated process? And we'd recommend talking to an advisor if you want to complete this backdoor process. But the benefit of this is for you guys is you put this money into that traditional IRA, non-deductible. There's no income limit. You can make $1 million. You can make $250,000. It doesn't matter how much you make for this. You're not getting the deductibility standpoint from that. But the real benefit of this is, say you put in that, let's say you put in $6,000. If you would have that in an IRA only, that money's taxable, as we talked about, when you pull it out, right? So with this backdoor strategy is We move this, we convert it to a Roth after, let's say a month, and then that money grows for the next 10, 15, 20 years until you retire. All that growth is now tax-free. And it comes out tax-free because it's in your Roth IRA like we talked about.
Yeah. So basically what I hear you saying is if you do not qualify for a Roth IRA contribution or even a traditional tax deductible IRA contribution because you make more than the limits, you still have an opportunity to contribute to not only an IRA, but better yet, convert it into a Roth.
Yeah, exactly. So really the benefits of this to keep in mind is, like you mentioned there, you also have to have the free cash flow to do so, of putting this money obviously in there. But if there is some sort of growth, because you are technically doing what's called a Roth conversion. So if there's any growth on that, say 6,000, it grew to 6,300, you would have a small taxable gain of $300
Right.
you got to report on your taxes. But in the grand scheme of things, in the long run, you're paying that $300 of taxable income up front, which hopefully is saving you tens of thousands of dollars in the long run on that growth of that money, if that makes sense. So you'd say, why do people want to do that? That's part of the case there, is you're getting that money tax-free. You also, like you talked about, you have RMDs, required minimum distributions for traditional IRA. By doing this backdoor strategy, converting it to a Roth, a big benefit also of that Roth IRA is not only is that tax-free income coming out of there, you don't have any required minimum distributions or RMDs as well. So that's where it comes into play of why you would want to do a backdoor Roth.
When would you not employ this strategy?
So kind of like we talked about, if you have money in a traditional IRA already, that's not going to work. And the reason for that is it's called a pro rata rule. So say you had $100,000 in a traditional IRA, simple IRA, somewhere along those lines. Or let's say $94,000 to give a better example. You contributed $6,000 and you said, Peter, I want to do a backdoor Roth because I make too much to contribute directly. You did that. Well, that's not fully non-deductible where you're converting it over, and we're talking about where, hey, if that was $6,000, you can move that over right away without paying any taxes. It's taking out at a portion then where you would $6,000 out of $100,000, only 6% of that is not taxable. So that's where it gets a little more complicated, and we'd say we'd highly recommend talking to your accountant's tax advisor, financial advisors at that point. But just so you guys are aware that, hey, this is a possibility. I can do this even if I make a lot of money and I'm successful.
Right. I think the other thing too is you do not want to employ a backdoor Roth strategy if you qualify to put into a regular Roth.
Exactly.
Right. It doesn't make sense to go through the rigmarole of this if you can just contribute directly to a Roth IRA.
Exactly. Complicated is not always better.
Right.
So if you can contribute directly to a Roth IRA, no need to do the backdoor IRA and make this more complex than it has to be. You're still getting all the advantages you would, but you can directly contribute. It's saving you the couple extra steps.
Yep.
And a big thing to keep in mind is you're not going to want to do this backdoor strategy, like you mentioned, if you can contribute directly to the Roth IRA. Also, if you need this money within the next 5 years, because this is a Roth conversion, keep in mind, not a direct contribution if you're doing a backdoor Roth. So you can't pull this money out right away without penalty. So this is a conversion, not a contribution. You have to wait those 5 years. It has to be over age 59 and a half to get any growth, etc. So that's a big thing to keep in mind if you already need that money.
So what I hear, there's quite a few rules, and you want to make sure that you do this right, because there are tax consequences if you do this wrong. So that's where someone like Peter or myself or someone else on our team can help you with that. But based on that, I want to just thank you guys for tuning in. Please like, subscribe, share with your friends and family. And if you have any questions, you can actually email us at moneymastery@mcglonesuttner.com. Thank you.
Thanks, guys.